Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. My guest on today's podcast is Wes Johnson. Wes is a certified financial planner, practitioner, and co-founder of ACT Advisors. In this episode, we discuss the tax-focused investment strategy called direct indexing, including what it is, how it works, and why it's so incredibly powerful, particularly for credit union leaders. Welcome to the show, Wes. We are delighted for you to join us today and to learn all about direct indexing.
Thanks, Doug. Thanks for having me.
Let's talk about direct indexing. I know from talking to our peers in the investment industry, there's a lot of investment people that don't know what direct indexing is. So I'm sure that means that our listeners from the credit union movement don't know what direct indexing is. So tell us about what is direct indexing, how does it work, and why should we care about this versus any other style of investing?
Okay, so what is direct indexing? All we're doing is we are replicating an existing index, but rather than just buy the ETF or a mutual fund that copies the index, we buy individual stocks that will replicate the behavior of that index. An example would be the S&P 500. You could just buy an S&P 500 mutual fund or ETF. They're dirt cheap. Or we can do a direct indexing account where we buy approximately 100 stocks. And those 100 stocks will replicate the 500 stocks that are in the S&P 500. So the next question would be, why would we do that? If we can buy the ETF or the mutual fund, why bother buying all these individual stocks? And there are a couple of reasons. The first one is, and this is the biggest one, is tax control. Direct indexing gives us the ability to do tax loss harvesting. And what that means is if you have a stock or a security and it has a loss on paper, you can sell that security and realize the loss, which you can then use on your tax return, and then immediately buy a very similar security or a security that behaves in the exact same way. That way your portfolio hasn't changed, the behavior of your portfolio hasn't changed, but you've realized those losses. Now, this only works in non-qualified accounts or non-retirement accounts, but the tax control is huge, especially during market volatility. We've had a few months of really rough market volatility, and that is an awesome time for direct indexing because we can do tax loss harvesting trades weekly sometimes and capture these losses. So we're still riding the roller coaster down, riding it back up. We're not getting out of stocks. We're just taking advantage of the losses on paper. So when we come through this thing, we'll have a significant amount of losses banked so that we can use those on the tax returns.
All right. So I want to repeat what I think I've heard is that with direct indexing, if we use the S&P as an example, the S&P is made up of 500 largest companies in the U.S. And if you just buy an index from Vanguard or wherever else to track the S&P, you'll get the result of the S&P. But what you're doing is using software to just get a smaller subset of securities and still track the S&P. Is that right?
You got it. Now, the index that we actually track is the Vanguard Total Stock Market Index, which is 3,300 stocks. We can replicate that index with about 250 individual stocks. And we like that index for a number of reasons, but the biggest reason is it contains large cap stocks, mid cap stocks, small cap stocks, growth and value. We have a lot more tax loss harvesting opportunities because we only hold 250 stocks. If we need to sell one, we've got over 3,000 to choose from that are in that index. So it's a lot easier to accomplish the goal of tax loss harvesting with that index as opposed to the S&P 500.
You're buying a subset of these 500 stocks, and then you are changing them, you said, as much as weekly. Now, all that activity must be expensive, all that trading activity.
It would be, except we custody the account on a platform that has no trading costs at all. And that's why direct indexing is in existence now, and it wasn't 5 years ago. There's a trading war cost amongst the various brokerage firms, Schwab, TD, Fidelity. They're a race to see who can be the cheapest. And now most of them are completely free for stock trades or ETF trades. So we can buy as many stocks as we want and we can sell as many as we want. And there are no ticket charges. There's no transaction costs. That did not exist 2 or 3 years ago.
So what is the incentive to do tax loss harvesting? Like, what is the historical amount of additional return you get and tax deduction?
We don't have a huge amount of data on this because, again, it's only been around for a fairly short amount of time, for a couple of years. But in the data that we've seen in the industry, on true after-tax dollars, we're seeing somewhere on average around 1% per year of extra return. In more ideal tax loss harvesting environments, like what we've seen here more recently, it's as high as 3 or 4%. But on average, let's just say somewhere around 1% of extra rate of return. You don't see it inside the portfolio. It shows up on your tax return, but it's there.
And how much of a difference does that make over time?
If you do that for 20 years, I mean, that's massive. I mean, that can be a 30% increase in your return over an extended period of time.
And then you're still tracking the return of the index. So you still get the same return you would have gotten anyways, right?
Exactly. We use some pretty sophisticated software to help the basket of stocks that we own. The goal is for it to track the index exactly as close as humanly possible. So even when we swap out securities, it's all done around trying to match the behavior of the index as close as possible. So yes, whatever index that we're tracking, your rate of return should be almost identical over time.
And you said that it can only be done in non-qualified accounts. Our listeners may not be familiar with that language, so you can talk a little bit about what does that mean? What does it not mean as far as 401ks and et cetera?
Retirement accounts are also known as qualified accounts. Non-retirement accounts are non-qualified accounts. There's a pretty important difference there. In your 401k or in an IRA or any qualified account, transactions don't generate tax consequences. Only withdrawals generate a tax consequence. So you can buy and sell stock all you want with no tax consequences in a retirement account. Non-qualified accounts or non-retirement accounts, everything that happens in that account is a taxable event. So in our industry, we will call those taxable accounts. Any dividend that you receive is a taxable event. If we sell something with a gain, that's a taxable event. So when we manage non-qualified accounts, or taxable accounts is what we call them, we have to be very careful of the tax consequences of any trades we make. But that's why direct indexing works so well for non-retirement accounts or non-qualified accounts, is because we can harvest those losses all along the way.
Let's talk a little bit more about those losses. So you're trading these things weekly, you're creating losses. How are our investors able to use those losses, and then do they expire after a period of time?
Great question. So let's just say we have an extended rough patch in the market like we have recently had. We've been harvesting a lot of losses. Those losses can be used to offset any future capital gains, any capital gains this year or future capital gains. So let's just say the market just continues giving us losses all year and we don't have any gains to match up with. In years where we don't have any gains, we can use up to $3,000 as just a deduction on your tax return, and then you carry forward the remaining losses forever. So you will use them all at some point. At some point, there will come a time where the market is really good and we need to incur some capital gains instead of capital losses. And sometimes there are scenarios where you want to incur capital gains. But the point is, you can carry those forward forever. And any year that you don't use them, or any year that you have extra to roll forward, you can reduce your income by $3,000 each of those years.
So the capital gains that you can offset, can they be capital gains from other investment activities, maybe real estate gains or other sorts of gains that you might have?
Absolutely. Doesn't have to be from the same account. Just any capital gains that hit your tax return, you can match up capital losses from the tax loss harvesting.
So if I can summarize what I've heard so far, so the use of direct indexing tracks the index that you might buy anyways. It doesn't add any cost to the exercise of tracking that index, and it creates this tax offset that can be used and carried forward indefinitely to reduce the tax effect of capital gains from this account or from any other account. Is that right?
You got it.
So that you just said a minute ago, sometimes it makes sense to harvest capital gains instead of capital losses. So, as our listeners may know, when a credit union executive has a split dollar plan and properly orders the way they spend their money in retirement, there is a period of time between retirement and mandatory distribution age, which is currently age 72. There's a period of time where we often see optimized financial plans with effective tax rates of 4 and 5% for those years between retirement and age 72. And of course, the credit union leaders that are paid pretty well, and we'll see effective tax rates of 30, 35% prior to retirement. So I think it's fairly obvious that in those high tax years, the tax loss harvesting would be pretty helpful to offset the income in those years. Talk to us about what the credit union leaders would do in those low tax years and how would the capital gains harvesting work?
Yeah, you bring up a very good point. Credit union executives it's one of the only industries that I've encountered where you go from a very, very high tax bracket to a very, very low tax bracket for a number of years, and then back to a high bracket once you hit required minimum distribution age. But so we would switch gears. Instead of harvesting losses, we would start taking some gains, because long-term capital gains, if you're in a lower tax bracket, current tax rules, if your tax bracket's low enough, they can be taxed at 0, or worst case, it's 15%. But we try to capture as many gains as we can without causing you to go up a tax bracket. So we want to harvest those while you're in a low bracket. And then once you are back into a high bracket, once your required minimum distributions kick in, then we switch it back to tax loss harvesting.
So in the pre-retirement years, we're tax loss harvesting to reduce the tax impact of any capital gains or ordinary income. And then in those early retirement years, we're capital gains harvesting, because at least for most of the clients that we see, they're in 0% capital gains for several years. So that's why you would harvest capital gains, because it can't beat 0, right? So as low as tax rate as you're going to get. And then when they hit required minimum distributions, we go back to plan A and tax loss harvest again to help reduce those other tax effects. So talk to me a little bit about the tailoring that you can do in the portfolio. Sometimes we see folks that have large concentrated positions. Sometimes folks are inclined towards charitable giving, and sometimes folks want to be socially responsible or use a social filter. Talk to us about how you could use those.
So there are two main reasons that people use direct indexing. The first is the tax loss harvesting that we already talked about. The other is customization. One area of customization, a big topic nowadays, is ESG, or environmental social governance investing, also called socially responsible investing. And you can get these mutual funds or ETFs. There's hundreds of them out there. But each of those mutual funds or ETFs, they have their own definition of what is a socially responsible fund. And the gist of a socially responsible fund is they avoid certain hot topics. Maybe it's weapons or alcohol or drugs or whatever it is. But what we've seen with our client base is that nobody seems to have the same definition of which industries they would like to avoid. With the direct indexing software that we use, we can pick and choose exactly which industries we want to eliminate. We may have a client that does not want to invest in any weapons, but they're okay with alcohol companies. So, everybody has their different definition of what a socially responsible investment portfolio looks like. We can customize it just about any way our clients want it customized. So that's one way that we can customize. The other one is with concentrated positions. We have a client that maybe they inherited a ton of individual company stock, or they work for, say, a pharmaceutical company. We can customize around that. We can avoid one particular company, or we can avoid an entire industry. If a client has a concentrated position in a pharmaceutical company, we can either avoid that company altogether, or we can avoid that entire industry. So we do have a lot of customization ability within the direct indexing software that we use.
Tell me about how does that software work with concentrated positions?
So if you own a lot of one stock, that's what we call a concentrated position. We can go into the software and say, do not buy this stock. We could even take it a step further and say, do not buy any stocks that behave like this stock or that are in this same industry. That helps reduce your exposure to any one company.
So kind of the key takeaway for me is that a credit union leader can't do this in their 401k or their 457B. this strategy only works for taxable assets. And in our work with credit union leaders, most of the time we see those taxable assets come from just plain saving money over time, or the payout of a 457F, or maybe a stay put bonus. And once they have those taxable assets, then they can use direct indexing to reduce their effective tax rate during the high income years, and then it takes advantage of no potential income tax during those very low income years that happen from retirement, acquired minimum distribution age. So it's a pretty interesting strategy, particularly for credit union leaders, because they have that tax delta that's so large, where you have that 37% rate for retirement, maybe 0% rate during the first years of retirement, and then back up to perhaps a 15% effective tax rate in the later years of retirement. So I think this is a pretty interesting strategy for credit union leaders. And I'm excited for the information you've presented for our listeners today. Any final takeaways or suggestions for how they can learn more about direct indexing?
You can always go to our website. If you go to act-advisors.com, there's a link at the top that says Credit Union Executives. And down below that, you'll find all the information you could want.
Awesome, Wes. Thanks for your time today. We appreciate your information.
Thanks for having me, Doug.
That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.